Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of how the corporate world works, and today we're digging into Virco Mfg, Corporation's latest financial report. It looks like they had a bit of a bumpy ride in some areas, but then saw some surprising comebacks. Let's see what is really going on behind these numbers. This is a quarterly report, meaning we get a snapshot of the company's financial health over a 3-month period, and this one covers the period ending the 31st of October 2025. It is kind of like checking in on a company's progress report card. Let's jump right into the balance sheets. Think of this as a snapshot of what the company owns and what it owes at specific points in time. On the 31st of October 2025, the company had total assets of about $181.5 million. Now that might sound like a lot, but compare it to the 31st of October 24, when they had over $210 million in assets. That is a significant drop. Where did that money go, or what did it get used for? Looking at their current assets, which are things they can easily turn into cash within a year, we see a similar trend. On the 31st of October 2025, total current assets were nearly $97 million. That is down from over $119 million at the same time the previous year. A big chunk of this is in their inventories. Inventories were around $53 million at the end of October 2025. This is a bit higher than the nearly $49 million a year ago, but interestingly lower than the $55.6 million at the end of January 2025. This suggests they might be working to reduce stock, which could be good if they are overstocked or bad if demand is dropping faster than they can sell. Their trade accounts receivables, that is money customers owe them, also dropped significantly from about $28 million in October 2024 to just under $14 million in October 2025. This likely reflects lower sales volume, which is a key factor we'll see later. Now for the physical stuff, property, plant, and equipment. This includes buildings and machinery. It stands at around $35.5 million, a number that has stayed fairly stable. Looking at the other side of the balance sheet, total liabilities and stockholders' equity on the 31st of October 2025 was around $181.5 million, down from over $210 million a year prior. Their current liabilities, the debts they need to pay soon, also went down from over $41 million in October 2024 to about $24.3 million in October 2025. This is a positive sign, meaning they are managing their short-term debts better. Specifically, other accrued liabilities dropped quite a bit too. And here is a key number. Total stockholders' equity, which represents the owner's stake in the company, increased slightly from about $115.8 million in October 2024 to $113.6 million in October 2025. While it looks like a slight decrease on paper, let's look at the components. The accumulated deficit, which is the total net losses a company has incurred over its lifetime, has shrunk dramatically from a negative $2.7 million a year ago to a much smaller negative $456,000 as of October 2025. This is a really good sign. It means the company is becoming profitable and is on its way to erasing its past losses. Their accumulated other comprehensive income or loss, which includes things like unrealized gains or losses on investments, has improved from a loss of over $1 million a year ago to a positive $220,000. This shows a general improvement in their overall financial picture. Now let's get to the income statement, because this is where we see how much money the company actually made. The biggest headline here is net sales. For the 3 months ending the 31st of October 2025, sales were about $47.6 million. That is a huge drop from the $82.6 million in the same period last year. That is almost a 43% decrease. And for the 9 months ending the 31st of October 2025, sales were $173.5 million, down from a massive $237.8 million in the previous year. That is a 27% decrease. The company itself mentions this drop is partly due to unusual disaster recovery shipments last year that boosted sales then. But even without that, they say sales are down. This is a clear indication that market conditions have changed. This drop in sales directly impacted their gross profit. For the 3 months, gross profit fell from $36.7 million to $18.1 million. And for the 9 months, it went from over $107 million to about $75 million. When sales go down, especially by this much, it is hard to maintain profitability. Costs of goods sold, which is the direct cost of making their products, as a percentage of sales went up. For the 3 months, it was 62% of sales compared to 55.6% last year. For For the 9 months, it was 56.8% versus 54.9%. This means it is costing them more to produce each dollar of sales, which is squeezing their margins. Now let's look at selling general and administrative expenses, or SG&A. This includes things like marketing, salaries for administrative staff, and office costs. These expenses actually went down in dollar amounts. For the 3 months, they fell from $25.6 million to $19.8 million. However, as a percentage of sales, SG&A actually went up significantly. For the 3 months, it jumped from 30.9% of sales last year to 41.5% this year. For the 9 months, it went from 30% to 35.4%. This is a classic sign that fixed costs like rent and core salaries are now a bigger burden on lower sales. They are not selling enough to cover those costs efficiently. Unsurprisingly, this all led to a net loss for the most recent 3-month period. They reported a net loss of $1.3 million compared to a substantial net income of $8.4 million a year ago. For the 9-month period, net income dropped from $27.4 million to $9.6 million. This translates to a basic loss per S-hair of 8 cents compared to earnings of 52 cents last year for the 3-month period. And for the 9 months, it is down to 61 cents per S-hair from $1.67. This is a pretty stark turnaround. It is interesting to note that the number of shares outstanding has slightly decreased. This means that even though they are making less money per share, they are returning some capital to shareholders through stock repurchases, which we will see in the cash flow statement. Looking at comprehensive income, which includes things beyond net income, they also reported a loss for the recent quarter, down from a significant gain last year. The cash flow statements tell us where the money is coming from and going. For the 9 months ended the 31st of October 2025, cash provided by operating activities was about $10 million. This is a massive drop from over $41 million in the same period last year. This decline in operating cash flow stems directly from the lower net income we just discussed. They managed to generate some cash by making their inventory work better for them. Inventory levels changed by a positive $2.6 million, meaning they likely sold off more inventory than they built up, unlike last year when inventory increased by over $9 million. However, their accounts payable and accrued liabilities decreased by over $13 million. This means they paid off a lot of their short-term debts. In normal times, this can be good, but coupled with lower operating cash flow, it means they had less cash available. On the investing side, they spent about $5.1 million on property, plant, and equipment. This is down from $5.4 million last year, so they are not investing heavily in new assets. And here is where we see them returning cash to shareholders. They spent about $4 million repurchasing their own stock in the first 9 months of 2025. Last year, they spent about $1.5 million on this. They also paid out cash dividends, spending about $1.2 million compared to $1.1 million last year. Ultimately, all of this resulted in a net decrease in cash of $358,000 for the 9-month period. This contrasts sharply with a significant increase of over $33 million the previous year. Their cash balance went from $26.9 million at the start of the period down to $26.5 million at the end. Looking at the statements of changes in stockholders' equity, we see the impact of these operations. On the 31st of October 2025, they had about 15.8 million shares outstanding, slightly down from 16.3 million a year earlier. Additional paid-in capital, which is the money shareholders have paid for stock above its par value, also decreased. And as we saw on the balance sheet, the accumulated deficit is shrinking rapidly, which is a very positive sign for future profitability. Now let's talk about their debt. They have a revolving credit line, but as of the 31st of October 2025, they had nothing drawn on it. This means they had full access to that credit line if needed, which is great for liquidity. Their other debt, which seems to be a mortgage on a building, is around $3.9 million. It is nice to see their total debt position is quite manageable. They recently amended their credit agreement. One change was a reduction in the revolving line of credit limit by $10 million. Specifically, the maximum limit during June through August was reduced from $70 million to $60 million. This indicates a possible shift in their credit needs or a response to market conditions. Let's delve into the management's discussion and analysis, the part where the company explains its performance. They explicitly state that the market for educational furniture is extremely seasonal, with about 50% of annual sales happening in June, July, and August. This explains why their sales numbers can look so different quarter to quarter. They acknowledge the big drop in net sales, attributing it not only to seasonality but also to unusual disaster recovery shipments last year and current macroeconomic uncertainty. They say the demand for their school furniture has been negatively affected. The order backlog is slightly down too. This shows that while they are still getting orders, the overall volume is less than last year. They expect most of this backlog to be delivered in the fourth quarter. They also mentioned that future growth rates might not match the surge seen during the COVID-19 recovery and supply chain disruptions. This is a realistic outlook, acknowledging that the extraordinary conditions of the past few years are fading. They highlight trade uncertainties and tariffs as a current risk, noting that it could affect their operating results. They are focusing on strengthening domestic capabilities, which is a smart move in uncertain global trade environments. They are not predicting a perfect rebound yet, but they are seeing global uncertainties as potential opportunities as well as challenges. As we saw in the financial tables, their gross margin took a hit. It was 38% in the latest quarter, down from 44.4% last year. They explain this is due to lower sales volume and production, even with some cost reductions in manufacturing. Essentially, they are making less profit on each item sold. And as predicted, the SG&A expenses as a percentage of sales have ballooned. This is because many of these costs don't decrease when sales drop, making the company less efficient. Their income statement shows a net loss for the 3-month period, and a significantly lower net income for the 9-month period. In the liquidity and capital resources section, they reiterate the seasonality of their business. They build inventory in the first half of the year to prepare for summer sales. They point out that accounts receivable are down, which is typically a consequence of lower sales. Inventory is up slightly. This could be due to rising material costs or a slow movement of goods despite reduced production. Capital expenditures, which is money spent on long-term assets like machinery, have decreased. They are spending less on growing their physical assets, which is understandable given the lower sales. Their cash position has decreased from $38.9 million in October 2024 down to $26.5 million in October 2025. They've been actively buying back their own stock, spending $4 million on it in the first 9 months of 2025. This is a way of returning money to shareholders, but it also reduces the amount of cash available for other uses. There is a lot going on with their credit agreement. They've had several amendments. One recent one, Amendment number 7, made some significant changes. It reduced the overall credit line limit and also lowered the seasonal over-advance amount. This suggests a tightening of credit terms, or perhaps the company's needs have changed. They also incurred some fees related to this amendment, which will be capitalized. Finally, in the risk factors section, they haven't reported any material changes since their last annual report. They point us back to their 10K filing for the full details of what could go wrong. This usually includes things like economic downturns, competition, and changes in government funding for schools. So, what is the big picture here? Virco Mfg. Corporation is clearly navigating a challenging market environment. The significant drop in sales and profits compared to last year is a major concern. Their core business, education furniture, is highly seasonal, and it seems that the unusual boost from disaster recovery orders last year masked some underlying softness that is now more apparent. The increase in SG&A as a percentage of sales means they're not as efficient as they used to be. However, a really positive sign is the shrinking accumulated deficit, which indicates they are on the path to profitability again. They're also managing their debt well and have access to credit if they need it. The stock buybacks show a commitment to shareholder value, but they do eat into cash reserves that are already lower. The company's strategy seems to be about managing through this period by controlling inventory, moderating production, and focusing on domestic capabilities to counter trade uncertainties. The big question will be how quickly demand for school furniture rebounds and if they can regain their previous sales volumes and margins. What is your take on Virco's performance? Do you think they can turn things around in the coming quarters? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next video.